This is one of the most important aspects of commercial real estate investing to protect your money and make sure you have positive cash flow. And so many people are clueless what DSCR stands for and also have to calculate that number. My real estate team's done $1.6 billion in transactions over the past few years, and this is one of the most important features to do when underwriting transactions. And I hope my clients make the best investments by knowing this, plus a lot more. You want extra support and help as well. In the meantime, down below, link in the description, or call me directly. But without further ado, what is DSCR? This is a term in commercial real estate that stands for debt service coverage ratio. Debt service coverage ratio allows us to know will a bank give us money for an asset. More than that, it also tells us will this asset cash flow on paper when we buy it. Now again, in this video I'm going to break down for you what to expect with DSCRs, but also that DSCRs by itself is not the full picture. You can still have a high 1.5% DSCR, which is good, and still lose money after you buy an asset if you do it incorrectly. So make sure you follow this whole entire video to see the best context behind that. Now, when it comes to debt service coverage ratio, what most banks look for is a 1.25. And sometimes it can be as low as 1% or 1 if the investor, or you in this case, has enough capital inside of your bank, or if you have a solid game plan to stabilize that asset and make it super high performing, that makes it a 1.25 or higher. This just means, in theory, that you make 25 cents for every $1 in there. So if you spend $10, you make $12.50, and this allows us to really know what we're getting ourselves into, that our property itself covers the debt, which is super important, because with DSCR loans, they don't care that much about your income and your credit scores to a degree. They care more about the asset itself, which is why it's a special loan that investors love, especially commercial real estate. Because, hey, this property is worth $10 million. The NOI is $1 million. And my debt coverage ratio is $750,000. So it kind of writes it out for you. If my property is 10 mil and my NOI, actually this is backwards, NOI is 1 mil and my property or asset is 10 mil, I have a 10% cap rate, which is super good fun. But that means if my debt coverage ratio to service this asset is 750K, that means I have a 1.33 cap DSCR, meaning that I make 33 cents per every single dollar in there. I'll write it down in full context for you pretty soon, because again, let's see the whole breakdown of NOI and all that stuff up above. Watch this video for more context on that. This is mostly focused on DSCRs. Now, for us to get to our DSCR number, as you already have seen, what we're looking for is going to be our NOI divided by our debt coverage. So if my NOI, let's do small numbers here, $1 million for the property, my NOI is $100,000. So let's say it's 100K here. And my debt coverage ratio to buy this property is 75K a year. So this is a year, this is a year. This means after I do my calculations, this property has a 1.33 DSCR. So I'm going to be cash flow from day one when I buy this property. Now, this is where most investors lose so much money by the wrong assets because all they're looking at is NOI and looking at DSCR. So it's two main things to look at. But commercial real estate, like anything else, it is still a risk. Stuff can go wrong every single day. So it's so crucial to just not do this alone, but also walk the property, see what's going on. Make sure you know the CapEx. This is capital expenditures. Capital expenditures can be plumbing, it could be roof, it could be occupancy rate dropping as soon as you buy it. There could be a lot of different things that are one cost, big one percentages, owner draws even, that are not part of this equation. Because DSCR, what it really is there for is to help the bank say, okay, I can make money on this loan. Here you go. Don't mess it up. If you mess it up a little bit, we're still protected. As long as it goes above 1, the bank makes money in theory. Now, what they're not doing for you is looking at the underlying issues. Is currently the management of this property terrible? Are people being charged a third of the going rate? If you increase it to the market rate, how much will you lose? Did you do an inspection before buying this asset? The apartment complex, storage units, RV parks, you name it. Did you do inspections on that asset? And did you find out the plumbing needs to be replaced? Did you find out the roof is in shambles? All these things have a massive role when it comes to making sure you know will you cash flow on this property. Because you can make, let's say, in this example here, $25,000 a year. So our net free cash flow is $25,000 a year, about $2K per month. But let's say the roof breaks and that costs you $25,000. You're now out of money. Let's say you lose 10% occupancy rate and you went from making 2K a month to making 1.5K a month or 1K a month. Boom, now you're in a hole $12,000. So you can see how quickly it can happen. Now, I'm not saying it's to scare you away from commercial real estate investing. I think it's the best asset class out there. This is why most billionaires buy commercial real estate. There are billionaires who buy single-family homes. A lot of my clients do as well. But more often than not, the biggest players are buying apartment complexes, they're buying massive RV parks, massive storage units, hotels, special purposes assets or multifamily assets, because those are the two best ones with the best returns for yourself. Up above, a whole breakdown as well, the top 5 subcategories of assets to buy in the commercial sector. But for now, just know when you're buying a property, DSCR, super important. NOI is super important. Net free cash flow is the most important thing, honestly, for investors to a degree. You're buying, but also plan for the future. Have a fund. Get a lender that can give you working capital. Like for mine, my lender we use for all clients, they can give us working capital, which is like a reverse equity play, meaning that if I buy this property for $1 million, that hey, give me $100,000 after we close in 2-3 days, so then buy more property. So then protect myself during this whole process if stuff goes awry. And they'll do that for you for like fraction of the cost, like $500 a month, depending on interest rates. It is an easy way to scale super quickly. And see how some people are buying 100, 300, 500 different assets in a 5-year period. So they're doing these kind of plays. If you want help with that as well, again, down below, link in the description. How to call me directly, no obligations, no strings attached. I can walk you through the best assets, next plans to actions for you if it's buying or selling. And of course, if you need help with my lenders to get you the best deals as well, that can be arranged for you too. Hopefully this makes sense to you. Again, I drop videos every single day about commercial real estate, luxury real estate, wealth building, mindset, entrepreneurship, and some of it's more. So make sure you like, subscribe, tag me from down below. And of course, you want more support over here, a whole breakdown, a whole playlist for you about all things investing. Up above, this is all about cap rates, how to analyze underwriting deals, to give this even more context for you. And of course, down below, What DSCR are you looking for? Is it a 1.25? Is it 1.5? Are you super conservative on a 2, which is hard to find? But again, down below, what DSCR is your risk tolerance? I love to see people's risk tolerance down below because everyone's different. Some people are like, hey, if it's a 0.75, I'll buy it. That means I can have a value to Class C and make an amazing asset to Class B and A afterwards and a huge, huge buyout. And I don't mind if I'm paying all cash, or I can bridge the gap with a bigger down payment to fix that. Also, not point two, with DSCRs as well, like a good deal become a bad deal based on how you structure it. So let's say you're buying a property that is $1 million and you do 10% down. That 10% down could give you at 1% because 100K debt coverage, 100K NOI, we got money. But if you put down 10%, then it's a good deal. Now it's 1.25 more or less, and then you do working capital on the back end. Now it's a great deal, and you have all that capital back that you would have spent anyway. So again, little ways to structure deals to make DSCRs loanable for you, and also it makes you money on day one. But it really depends on what you're looking at, what's the coverage of the property, what is the expenses, what is the NOI, obviously, and so much more. But of course, thanks for being here. I'll see you at the top. Have the best day yet, and happy to have you part of this channel.